Well guys, the results are in. Tesla just reported earnings and it seems like the bulls are back. Tesla was up 10% in after hours after some great forward guidance that the street really liked. Now the question remains, can the momentum continue? Today we're going to answer that question and look at some of the other data points we got this week. It isn't all rainbows and sunshine, and the market seems to be ignoring some very questionable economic data in favor of earnings data. So today we're going to break down everything, the macro, the fundamental, to give you a full picture of where we are and where we're going. But we also need to talk about the S&P 500. Our 5,000 buy zone worked like a charm. We've recaptured key levels and we need to talk about what comes next. Can the bulls continue their momentum or will the bears finally step in? Today, we're going to answer that and much more. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Guys, and another green day, another broad-based rally in every single sector. Tech, comp services, discretionary, even consumer defensives put up a pretty good day, except for a couple of isolated names. I'm looking at Pepsi. We'll talk about why. I'm looking at Walmart. Healthcare plans continue to come a bit under pressure, but they had a fantastic week last week. So you give some, you lose some, such goes the market. But guys, we saw upbeat action in industrials was led here by GE. Real estate as a whole rallied on the back of rates. Energy too, oil was up quite significantly. We're going to talk about all of this. Utilities, GEV, right? Again, with the GE trade, they all did really well. Absolutely rallied, lifting utilities, lifting the market as a whole. And then financials, guys, capital markets here, we're seeing some major strength in this sector. Look at American Express up 2.56% along with MasterCard, Visa. We're going to talk about Visa's earnings, guys. A very upbeat day today. You couldn't really fault any of the action today. You no longer say this is a dead cat bounce because we saw strong buying, strong volume, broad-based across all indices, across all sectors. And let's actually have a look at some of these sectors, right? Look at the top performing sectors. IT that had to do with some of the home sales data that we got today. Came in a lot better than expected. We also had semiconductors up 2.3%, software, then gold miners right here up 1.6%, XLC up 1.52%, technology, XLI up 1.3%, XLV, XLY. Guys, look at this. KRE underperformed the SPY and still put up a 1.14% day. Real estate up 0.9%. The only two negative sectors was materials right here, metals and mining. And you know, they had a fantastic run last week. Like I said, you give some to lose some. It is what it is. It's the name of the game. But let's actually talk about why we rallied. So a couple of things. Number one, housing data came in really good. That helped home builders, that helped cyclical sectors, right? Secondly, softer than expected PMIs. Now PMIs came in soft, but not too soft because the composite PMI was still above 50, which is expansion, by the way, even though it missed its expectation, and that did help the inflation front. And then we saw manufacturing PMI decline to 49.9, just below expansion territory. This is what was expected, and this actually helped the inflation story. As a result, yields dipped, and the reason why we also saw the upbeat action had to do with pre-market earnings. A lot of them came in a lot stronger than expected. Now let's actually talk about earnings, guys. So today we're actually going to focus our energy on Tesla and Visa, but we had a couple of pre-market releases that I'll quickly go over. Spotify surged 11%, surpassing Wall Street's expectations of its first quarter estimates and rosy second quarter guidance. UPS also reported today. Their shares were up 2.4% after better than expected earnings. I believe they beat on both the top line and the bottom line. Shares of GE were up 8.3% after again a double beat on earnings and great guidance. Pepsi also reported their stock was down 3% on the day because they had to recall a bunch of products in the quarter. Also, they said that the lower income consumer hurt US demand. However, they did report a double beat on both the revenue and the earnings side. So the market reading into future demand here for Pepsi versus what they actually reported. So in the aggregate reporting earnings for Pepsi, they did do well. It's just that, looking ahead, the market didn't like what it was seeing. But before we dive into Tesla and Visa, let's actually get a quick overview of our earnings scorecard. So right now, S&P 500 revenue growth Q1 2024. The expectation at the start of earnings season is 3.5%. We have reported so far 3.5% in revenue growth. growth. On the earnings side, the expectation is 3.4%. We've reported 0.5%, and that largely has to do with the fact that the S&P 495 is expected to report -6% earnings, and then these 5 companies, Amazon, Google, Meta, Microsoft, Nvidia, are expected to report 64.3% growth in earnings year over year. And once they roll their earnings into the index, we're going to see drastic improvements in overall earnings. And you can see here that for the rest of Q2, Q3, Q4, these 5 companies will continue to drive earnings against the broader market. But we do see the broader market actually pull its own weight in the second and third quarter year with 6.2%, 7.3%, and then double-digit growth for the overall S&P 500 year in the fourth quarter of 2024. Now let's get into Tesla. Double miss, guys. A double miss, an actual dumpster fire. So they were supposed to report EPS of 50 cents. 45 cents was recorded on sales here of $2.31 billion. The market was expecting 22.6. However, it's not all bad news because they were up 7% in after hours. On news, Tesla's working on a ride-hailing app and they're going to launch more affordable models to the market. I haven't seen any guidance figure for Tesla. However, the market really did like the ride-hailing app as well as these affordable models. And we all know that the street looks more towards forward guidance than it does the current quarter. So you can actually miss right here. You have some upbeat guidance and the market's going to reward you. They were up 7% in after hours. And this is some pictures of Tesla's ride-hailing app. I know the image is not that great, but you can definitely see that they're going to really push some competition towards Uber, towards Lyft. Both Uber and Lyft were down more than 1% in the pre-market on this news here by Tesla. So competition heating up in this space, but really good news for Tesla investors, a bit of a tailwind there for you guys. But we'll see how this translates into trade throughout the rest of the week. Maybe this was just an initial pop on enthusiasm, but what really matters is the trading going forward into this week, into next week, into the rest of the year. Now let's actually talk about Visa, and this stock, one of the biggest holdings in my retirement account, absolutely killed earnings, a double beat, EPS of 251 on sales of 8.775 billion. We were expecting 8.6 and the EPS expectation was 2.4. So check. They were up 3% in after hours because guidance growth was at the high end of their double-digit estimates or what the street was expecting, and they affirmed their 2024 adjusted EPS growth in the low teens. Sometimes the best investments are just the simplest, right? Buy what works, and Visa works. Now let's actually have a look at some earnings commentary. This is data from ALGO. I've just copy and pasted it. Now the blended earnings growth rate currently for the S&P 500 is at 6%. If the energy sector is included, 5.6%. Now, Q1 consensus estimates reflect a $12 billion one-time charge for BMY for their Karuna Therapeutics. So including this one-time charge, the earnings growth rate is actually 2.9%. Now, this is where it gets kind of crazy, right? Right here. 102 companies have reported earnings in the S&P 500. 79% have beat analyst expectations. That's why we're seeing upbeat action in the market right now, because earnings are coming in a lot better than expected. This compares to the long-term average of 66%. By the way, the blended revenue growth rate is 3.4%. Excluding energy, the growth rate is actually at 4.2%. So very strong earnings so far, all things considered. Before we get into the rest of the video, let's hop on the charts. Alright guys, look at the breadth right here. S&P 500 up 1.2%, 1.5% for the NDX. The RSP was up 0.89%, mid-caps 1.2%. Look at small caps, IWM, S&P 600. Absolutely crazy. They actually have been beating the S&P 500 and Nasdaq, not just in today or yesterday's trade, but on this rally down, they've actually outperformed on the way down. I mean, the S&P 500 was down like 2.56% last week. The RSP was actually only, the IWM was only down like 1.1%. Guys, and we definitely saw growth outperformed value, but not to say that value didn't put up a good day. A little bit of downbeat action here in value after hours. Now you could actually have a look at bonds, right? So bonds actually caught a bit of a bid here today. They were up 0.2%. The AWG, TLT up ever so slightly. We saw a move into high yield and corporate bonds, and that just meant that yields fell, and that did like support equities as well as these higher beta names right here. So we saw Bitcoin actually fall 0.78%. The same is true here with gold. Silver was up after down 5% yesterday. The dollar lost, and this is also what really helped stocks. 0.5% down in the DXY, and then crude was up 1.78%. I didn't really see any news as to why that is, so maybe we're just seeing normal volatility there in crude traders, placing bets, maybe liking this area right here, looking for the $87, $88 mark. But let's hop on the S&P 500 really quick, guys. So a couple things to note. If you're new to this channel, on the weekend video, go check it out. I said this right here, 4920 to 5000 is the buy zone. In fact, I said we want to be buying in this zone right here on this candle, and I said we were going to pull back all the way to this zone. This is where we are right now. We actually did bounce in this zone right here, and then yesterday I said yes, we had a very green day, but I didn't like the action on the 5-minute chart. And what I said is that the S&P 500 needed to go and retake this level right here, the 50.68 50.69 level, and it did exactly that. We actually closed at the 50.70 level. This is very constructive, and now what the S&P 500 needs to do, move from here, okay? Like move up, use as support, and then go higher, or don't even use that support, just rally from there, maybe gap up. We know that Visa's earnings were good. There is a bit of a risk if we do, drift down overnight into this area right here, then we can actually have a little bit of a pullback, but I don't think it's anything really to worry about as long as we stay above yesterday's close. So we could pull back all the way to here, even maybe to this 5,000 level, to be honest. We could pull all the way back here, and then we would still be in the context of, I guess, this rebound. So we could pull back all the way to here and then move up higher. With how earnings are coming in, the fact that we're in the bulk of the reporting season, we have stuff like Meta reporting tomorrow. We have a couple of bigger names in the restaurant industry as well as Ford. If they come in good pre-market, we could definitely see a bump and then rally to go ahead and take this candle. And that's really the next target for the S&P 500. Right now, if you didn't buy the dip, you probably missed out. And the next target the S&P 500 needs to go for is 51.49 right there. So that's the target, So from here, rally all the way up. You could use as support and then go for the rally right there. If we do drift lower, there is some strong levels of support right here at the 50.25, 5,000 level, but ideally just above the 5,000 level right there. Use that as support and go up. But what do I favor personally? I think we're just going to continue the rally. I think we can maybe have like a flat day tomorrow, have all of the after hour earnings come in, and then rally, on Thursday into Friday, into the weekend, and then finish in this range right here, or very close to the 41.49, 41.50 level, which is our gamma flip zone, by the way. Now let's actually just hop on the 5-minute chart. Looking at the 5-minute chart, we gapped up right here, and then we just absolutely went right to our main level, which was the 50.68, 50.69, 50.70 level, and then we kind of traded sideways here for the most part. And this is constructive price action on the 5-minute chart. We gapped up, we closed at the high of the day. Look at the SPY up 0.1% here in after hours. So things looking very good for higher price action, higher movement in the S&P 500. So we could definitely see something like maybe a flat day tomorrow and then continuation to like a flat day continuation. And I do think that if we drift into this zone right here, this zone, I think we're probably going to go towards the gamma flip zone, which is the call gamma resistance zone here at 51.50. Very constructive. So yeah, and it seems that risk is to the upside. We have strong support levels here on the downside. We have very clear levels to the upside, especially with this candle right here. Very thin volume to get to this level, this 51.49 level, and that's probably where we're going to finish. Maybe not this week, but probably somewhere middle of next week once we get the bulk of earnings done. If earnings do continue to beat to the upside, definitely see the 51.49 area in due order. Now guys, let's dive into sentiment. These are charts we look at every single week. Bofa's bull bear indicator, Goldman Sachs sentiment indicator, two very reliable indicators that I really like looking at and keeping track of, and we keep track of them every single week on this channel. So if you want the latest, go ahead, subscribe below so you don't miss a beat, guys. Now, over the last few weeks, these sentiment indicators, as you can see right here, have been in stretched positioning, as well as the Bofa bull bear indicator has actually moved from the 7.1 position all the way to the 5 position. And right here, I was telling all of you guys that it's just time to hold equities, hold what you got, because things are getting a little bit frothy. What do you know? 4 to 5% pullback later, we've moved down to the 5 handle. We're below stretch positioning. And while the sentiment indicators are still telling us it's time to hold, what they're also signaling, at least the Bofa bull bear indicator here, actually both of them to be honest, what they're both signaling is that it's time to nibble. It's time to add a little bit to your positions. I actually bought some more PayPal yesterday. I bought some S&P 500 and I bought some MOAT, ticker MOAT, great ETF. Go check it out. So I added a little bit more. If the market does pull back another 4 to 5%, I'm going to add a bit more. But if we then rally from here, I do have added exposure to my portfolio overall, as well as the original positions I already have in my undervalued portfolio, my top picks portfolio, my pure alpha portfolio, as well as my ETF portfolio. We got portfolios all over the place. But sentiment right now, guys, is signaling that it's time to get a bit active, so start getting active. Now, one of the big reasons why we actually pulled back has to do with inflation. Inflation data is coming a bit hot. It spooked the market, and we have a big inflation print this week, PCE on Friday. Now, with regards to PCE, we are expecting the headline to come in at 0.3% month over month and 2.6% year over year. For PCE core, the expectation is again 0.3% month over month and 2.7% year over year. If we get a figure any bigger than 0.3, that's going to affect the year over year figure, and that could be seen as a hot number. However, a major component of PCE CPI inflation as a whole actually has to do with shelter. This is the housing component of PCE, and BOFA's forecasts relative to other leading indexes that measures shelter inflation. And pretty much Goldman Sachs expect shelter inflation to do this. That's their new forecast. So let's actually quickly read what they had to say. They say the official measures of shelter inflation have lagged leading indicators by much longer than usual because of the large gap between rents paid by existing tenants and new tenant market rates. We adapted our forecast approach to explicitly account for this gap in late 2022, as you can see right here. They also left another note with this piece of research, and I quote, while the most watched leading indicators have run at a 1.5% annualized rate over the last 18 months, the official shelter measure that the Fed use has increased by more than 5% annualized since March. So pretty much the Fed's official shelter measure is actually keeping inflation overall sticky, because that's not what the market is experiencing, at least according to Goldman Sachs, CoStar, Zillow, and a bunch of other leading indicators. But as you can see right here, BOFA expect continued disinflation in shelter in 2024, particularly after the midpoint year. You could see a steep drop off where inflation takes a dive. However, we do have to note that these leading shelter inflation measures are actually increasing, and that can be a risk factor to actually keep the Fed's shelter measure rather inflated over the next year, 2 years. So we're going to have to keep a close eye on shelter inflation in particular, because if this starts moving in the direction we don't want, we can really see shelter inflation actually accelerate into 2024, and that's bad for equities. Now, how does this actually help us with our trading? It's very, very simple. I have some data right here, and it's S&P 500 performance before and after the PCE report release. Now, we have the data since September 2022 when this bull market started. You can see here that 5 days leading into a PCE print, the average return 0.28%, 1 day before 0.35%, 1 day after the PCE report is nearly 0.5% return. Look at these hit rates, fairly alright. Maybe 1 day before is not that good, but 5 days and 1 day after is pretty good. 5 days after is actually 0.14. Take this with a grain of salt. If you remove this figure right here, which was the September 2023 print, this figure will actually be negative. This was an outlier month, and then 1 month after we can actually expect about a 1% return here. So we can get a little bit of volatility here in the interim, in the immediate week after PCE. You know, the market gets nervous, that sort of thing. They want to de-risk into the weekend. So we can see a bit of volatility here. We saw most of that volatility in 2022, where negative 2.3, negative 3.6. But in recent months, we've actually seen that volatility subside, and we've actually seen some positive months too. However, last month we did have a full 1% down after that hot print. That being said, the data is here for you guys to use. And generally speaking, what this data tells us is that if you want to be long into a PCE print, it's not necessarily a bad idea, but it's probably better to just wait for the data and then maybe get into the trade somewhere between 1 and 5 days after PCE, and then hold for a full month after, where you can get outsized returns. And particularly look at some of these returns: 4%, 10.9%, 4.4, 2.9, 4.2, 2.9%. Bit rough go here, the month of March into April, and do expect that if we do get hot prints, we will continue to see downside momentum in this market. The inflation scare is absolutely terrible for stocks as a whole. Now, on the topic of inflation, let's actually have a look at some analogs with regards to CPI and energy. This was inflation in the 1970s. The second inflation wave hit in the 70s, and it was fueled by an oil shock and the Yom Kippur War. Now you can see that this is the war right here. This dark blue line is CPI. This is energy, and we had an energy shock, as you can see. And this shock right here largely had to do with the war drastically affecting the supply side of oil. And when you have a supply imbalance, it leads to higher prices, and higher oil prices will be reflected in overall inflation, which we saw in the CPI year over year in 1973, 1974, 1975. And we saw that in the last two PCE and CPI prints. Energy has rallied for the last 2 to 3 months, February, March, April, and the inflation prints have come in a little bit hotter than expected. And that's exactly the thing. Higher oil prices can bring higher inflation because they're so volatile and they affect the consumer directly. Now, the 1970s and the 1980s was a vastly different time for oil. The US supply of oil was very, very limited, and we really did rely on most of the Middle East, a little bit of South America, quite a bit here in Southeast Asia to supply oil to the rest of the world. And obviously you get infrastructure damage because of a war, and you're going to see major oil spikes. The economy is very different now. It's well more diversified. While something like this could happen, it's highly unlikely we're going to get an energy shock unless we have a demand driven issue like we saw in 2020 with COVID. Now, let's say we are to get that inflation shock, that energy shock. Where can you actually hedge your bets? Now, Goldman have some data here. All 11 sectors in the S&P 500 fell during the oil shock in 1973 to 1974. Gold, however, was the best performing asset. And this is the performance between the Yom Kippur War and peak energy inflation. And you can see in a 12-month period right here, gold returned 54%. Every other asset class was negative, including treasuries. They were down 5%. And this data tells me you don't want to be in equities when there's an inflation scare and when there's an oil shock. Gold is your best bet in such a situation. So for those of you that are worried about geopolitical events, go ahead, buy some gold, because if things do ramp up in the way you think they might, it's actually a great hedge, all things considered. Now, while this is actually very interesting data, very relevant data, and it can help us make informed decisions in the future, it was really only one 12-month period in one very specific time in the world, and the economy is vastly different. We actually have to look at much more data points to actually get a full picture as to what happens during these tense geopolitical times, and I have the data. And this is just some seasonal data. S&P 500 peak to trough declines have been 8% on average during major macro shocks / geopolitical events, but more than fully recovered after 3 months. So essentially macro shocks, geopolitical events, and you could see here, let's just pick a random one, right? We'll just pick this top one because it's easy to read. S&P downgrades Greek sovereign debt junk first Greek bailout. So I believe this was probably in 2013. It wasn't quite in 2008 and near the financial crisis. It was a couple years after when Greece had their financial crisis. Now you can see the S&P 500 1 month before up 3.9%. 1 day before the downgrade down 0.4%. On the day of the downgrade, the S&P 500 lost 2.3%. 1 month later, the S&P 500 was down 9%. 3 months later, 8%, with a peak to trough drawdown of negative 16%. That is absolutely crazy. And then 3 months after the event and the trough of the S&P 500, we actually saw a 9% gain. And then trough days after, before the event, was 66. So you guys can go through this data set right here. It's obviously all going to average out, but generally speaking, guys, when we do get these type of events, you want to sit through the volatility and hold the line, because the average does say 3 months later, it more than fully recovers. In other words, more than fully recovers means if you had $100 in S&P, this hits, you lose 8%, you now have 92. 3 months later, you're going to have 101. So maybe you want an oil shock because you just get more S&P 500. You just have more equity at the end of it. Now let's talk about seasonality, guys. I showed you this chart yesterday. In periods where we've had a massive start to pre-election years, this period right here, sort of like the April, May, June, July period, we normally do get quite a bit of a drawdown, quite a bit of a pullback. And that's what we're seeing in the S&P 500 right now. What you really want to look at this is an opportunity to buy the weakness, because generally speaking, history history does show that after big starts to the year, we pull back very early on in the year and then have a very strong end of year run into this August, September, October, November, December period. Now, let's look at market breadth. Now, market breadth isn't the greatest. It's actually fairly muted here in the S&P 500 and S&P 400. However, there is a couple of trends we are starting to see. 3 and 4 days ago, stocks at 1 month lows, 3 month lows, and 6 month lows actually formed a bottom right there. Now, we still have elevated stocks at these lows, as you can see, 34%, 33%, 25%, but this number actually is decreasing from the highs we saw here at 53.1%. The same is true here for mid caps, 1 month lows, 3 month lows, 6 months and 12 month lows as well. And then small caps, the same is true as well. So about 3 or 4 days ago, that was the bottom in breadth. And if this continues, we will see further upside in stocks. Breadth is one of the best indicators to look at when it comes to the market. However, as much as we see stocks at these 1 month lows, 3 month lows, what we also want to see is this right here. Stocks at 1 month highs, 3 month highs, 6 month highs. Just because these are coming down, if these are not increasing in a material way, what we're actually going to get is just chop in the indexes. All in all, breadth is improving, but we want to see further improvement in these metrics. Now, looking at the core market model, these are some charts we look at every single week. The core market model is just below the zero line right here, which means that it is becoming a slightly risk-off environment. However, we do have to understand that sometimes we can hit below, and we are finding support at this level right here. And based on the massive trend we've seen, I would say that you still want to be risk on, at least until we actually get further movement into this oversold or extreme oversold territory. At the same time, the core leadership model, however, which is mostly based on breadth, has actually just hit this weak leadership line right here. Now, that is because we've seen a lot of stocks pull back to their 1 month, 3 month, 6 months lows, as I've just showed you. So the core leadership model is risk off. Now, looking at the NYSE composite, so new highs versus new lows, we can actually see an uptick in new highs versus new lows, and that's very good. However, we are still printing more lows than highs, but what you really want to look at is the trend. You see, the trend right here is what matters. The trend right here is what matters. The second we go up and make new highs versus new lows, that's when breadth improves, and that's what we really want to see in this market. So we're going to keep a close eye on new highs versus new lows across all of the indexes. Now, this is the risk on, risk off ratio. These are the instruments we use, and we're still very much risk on, although we have pulled back in a material way, but in the grand scheme of things, it's not that big. We can really start to get looking to be risk off once we get below this line right here. And as it is right now, you still want to be risk on. You just want to sit through the volatility. And what all of these charts are telling us is that things were starting to look risk off. We just haven't seen the follow through from the bears to warrant any longer term worry. And we should really look at all of these moves as simply buying opportunities, not reasons to sell or get out of equities. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.